1991, a 21-year-old actuarial science student presented an honors thesis at UCT, suggesting that South African pension funds could invest on commercial terms while at the same time achieving developmental outcomes. 2 years later, that same student would walk into Southern Life and pitch to the CEO. They accepted, and this became the genesis of what is today Futuregrowth. And the fund that came from that was the Infrastructure and Development Bond Fund, one of the oldest infrastructure debt funds in Africa. My name is Vuyono Ganji, and I am CEO at Futuregrowth. This is the first of a three-part series, and today I am joined by two people who have been at Futuregrowth for over 25 years each. Jason Lightfoot is our Senior Portfolio Manager and has managed the IDBF for much of the last 2 decades. Daphne Botha is a Portfolio Manager and the Head of Risk Management and sits on the Investment Committee. Welcome.
Thank you, Ver.
So I'm going to ask my first question to Jason. Jason, the IDBF fund launched in the mid-1990s when infrastructure debt was not recognized as an asset class. Pension fund trustees had never allocated to it. In fact, the country had just held its first democratic election, and RDP was the economic blueprint. Take us back to those early days. What was the investment case that you were making to trustees who had to frame this for their own particular beneficiaries?
Great, thanks, Ver. Going back to that time, I wasn't part of the team back then, but ultimately it was a brilliant idea, and I feel very privileged to be part of an organization that was founded on that initial thesis. My sense in terms of my conversations that I had with Michael was that it was really a leap of faith that was taken by those initial clients. There's no benchmark that was evident in the market, no comparable opportunities in the market. It got to a point where it was actually a case of trust the cash flows, trust the contractual underlying legal agreements, and ultimately the returns will follow. What I found really amazing was that some of those early investors in the fund are still invested in the fund at this point in time.
All right. And Daphne, you came shortly thereafter. Anything that you sort of felt is worth sharing in terms of the time at that point in time?
I think what is worth noting is that, responsible investing wasn't a theme back then. The changes to Regulation 28 only came recently. So how we sold the product was, at its core, the Infrastructure Bond Fund is a bond fund. So you're making an allocation to the bond asset class, but we're also adding this additional benefit of developmental investing. And so you're getting the best of both worlds. It was a hard sell in the early days. As Jason mentioned, we had those first pioneering investors who put their faith in us, well-founded faith, as it proved to be. But it required an initial hard sell, and it took a bit of time to take off. So the fund was very small when I joined. It was around R1 billion. It's around 27 billion rand now. But the growth in the first 10 years was slow.
Sure, moments of faith, Daphne. I'm actually going to just stay with you there. Joining the firm around 2001, the firm actually had 40 billion in assets at the time, next to this 1 billion that you speak to. Tell us, in terms of the Futuregrowth back then, when you think about the operational and risk infrastructure, what comes to mind when you think about that at that time?
It was a very unstructured world. If you think just from a regulatory perspective, it wasn't as regulated as the financial markets are right now. From a Futuregrowth internal perspective, operationally, again, it was also relatively unstructured. What we did have, though, is we had the beginnings of what would now be called a data warehouse. It was called FIDO, the Fixed Interest Data Organizer. In there, we managed and monitored data about every single instrument we held in our portfolios. That I felt was pioneering, and it helped us establish reporting to measure the impact we would have in funds later on. So it was a good starting point. It was a starting point. It wasn't the end. We needed a whole lot more development post that to get to something a lot better in terms of responsible investing reporting.
And what does this FIDO look like compared to now?
Now, so back in, I think it was between 2016 and 2019, we added a data warehouse. It's called InfoStore. So back then, FIDO probably had about, I'm guessing here now, about 80 data fields per instrument. Now we're talking 200-300 data fields per instrument. And what are those fields? What's this data that we are managing and looking at? So there's financial data. What's the market value? What's the holding? But there are other things. Is like, what economic sector is that serving? What's our pricing around the instrument? Who rates this deal? Is it Moody's, S&P, or an internal rating? But if you look at some of the social metrics, we had a field called dilution. How close to the consumer or how far from the consumer is a deal? If you think about a toll road, people drive the roads every day. So it's really close to the consumer as opposed to a intermediated financial transaction. It's a number of layers away from the consumer. So thinking about that and coming up with that was actually quite exciting. You're creating something that's groundbreaking, because I don't think anybody was thinking about it at that time.
Yes, except
Futuregrowth.
Michael, Futuregrowth, right? I'd like you to lead on the next one, Daphne, and then Jason also just share your thoughts on the piece. So the founding thesis really was around developmental investments can deliver commercial returns. It sounds tidy in retrospect. In practice, the early team had to deal by deal. What counted as developmental, what didn't. And maybe just jumping to you, Daphne, then, was there a deal in those early years that really tested where the line sat between developmental investing and commercial prudence?
So firstly, I think when I mentioned there weren't that many pure developmental deals. It was principally still a space that the banks dominated in. So Futuregrowth as an institutional investors knew we're breaking ground into this area. There's one deal that's still stuck in my head after all these years, and that was whether or not a prison is considered a developmental investing. It required multiple rounds of debates. And in the end, we decided not to go with the deal. The details I can't remember right now. But it's an interesting conundrum. Prison, that legal infrastructure is part of society. So it was a tough debate. More recent questions around infrastructure or developmental investing is whether to invest in coal or not. That was a much easier decision, actually, in the end. We decided that it's not socially acceptable, but you know what, we need power. And at the base, coal-fired power plants are still the primary source of electricity in South Africa. Hopefully that will change in the next decade.
Jason, any thoughts just on how it's affected how you think about deal selection now?
I mean, maybe to add some more color to the prison deal. I mean, on the face of it, it was an infrastructure deal. If you think about it, it's infrastructure. You've got an off-taker in the form of the underlying government, so you've got certainty of cash flows. But I think the whole idea around incarcerating people in a prison sort of setting wasn't the sort of developmental focus that the fund wanted to achieve ultimately. And that was kind of the primary driver why we decided not to invest into a prison.
Okay. And in terms of how you thought about deal selection, so those early deals, how they influenced you today?
Yeah, I mean, if I go back a few years, one of the deals that I still remember is a transaction where we provided funding to Grace Bible Church. So they were a community-based church that were originally operating out of a hall. Very few members in the early 80s, grew to thousands of members that were operating out of a makeshift tent. And they were looking for a permanent home ultimately. So on the face of it, not really a bankable deal, because how do you fund a church? So you need to like dig deep, do the due diligence, look at the underlying details. So we did a lot of stress testing on the tithes. Ultimately, resulted in a signed risk-adjusted deal, which they were then able to pay back 2 years earlier. Now, again, in the funding game, it's primarily relationship driven, and that afforded us the opportunity to fund phase 2, where they wanted to build a community center on that same piece of land. So really a great deal in all remarks.
Lots of learnings there. So Jason, what I do want to touch on then is a little takeaway from, I guess, the investment piece, but just focusing on the history of the firm, looking at the firm coming through Southern Asset Management, which is later acquired by Old Mutual. Southern Life at that point gets written down to zero, and Futuregrowth survives through this transition. So you've watched the firm go through multiple ownership transitions and leadership transitions in the firm. What is it about the way the fund is built that's allowed it to carry through all of that?
Yeah, I think the main premise around that is the underlying philosophical and fiduciary approach had remained intact despite changes from a boardroom perspective. The underlying approach in terms of how we look at credit, how we transact in the markets, remained intact despite changes in that environment. And that really saw the fund through, ensuring that we uphold our promises to our clients. So even though Southern Life might have disappeared, Futuregrowth remained.
And do you think there's something structural about an infrastructure and debt fund, that long-dated cash flow, the contractual nature, that makes it more resilient than people would expect?
So if you look at a typical project finance type of transaction, you are very much reliant on those contractual cash flows. They are very, very important. But obviously you need to do deep due diligence in terms of your off-taker, where are those cash flows coming from, how sound are those legal agreements that you enter into. Obviously looking at governance requirements as well. Daphne spoke earlier about alignment of interest. Is the underlying equity funder putting enough equity on the table? And obviously, if you look at infrastructure assets, there's obviously a much lower correlation to typical listed equity and credit investments.
Yes. And definitely, let's jump on a little bit to crisis mode. When you think about the fund, it's 30 years old, so it's a long-term track record, and it has to have been through things that changed how it operates through time, how you think about it. Which crisis do you think tested the way you manage the risk, and what did you actually change afterwards?
Having been here a long time, we've been through a couple. So off the top of my head, obviously the first big one was the global financial crisis back in 2008. Then there was Taper Tantrum in 2013. You had Nenegate in 2015, and the whole state capture story around that at the time. And then the real big test was COVID-19. So I think I still remember the date, 16 March 2020 was the first time it touched our market. Our market sold off aggressively on that day. And for that 2 weeks that followed, we had a huge amount of volatility. Most of it in the earlier part of the 2 weeks, because at some point the market stopped trading. And that is the thing that really tested us. What these market events do is that they reduce market liquidity. And so that is the one thing that the market needs. Market trades on sentiment, and liquidity is an outcome of that sentiment. So we got to a point where we wanted to buy bonds, we couldn't. We couldn't trade 5 million. We're a bond house, a big bonds house, and we couldn't trade 5 million. During that period, we built up a relationship with the Reserve Bank. Unfortunately, they couldn't speak to us because they were in a closed period ahead of the Monetary Policy Committee meeting. So we had to wait until the MPC repo rate announcement happened. I think it was around the 26th, 27th of March. And the day after, we could have a conversation. And they've listened to our story, and bought secondary market bonds that brought a huge amount of liquidity back into the market. So what you have to understand is during that period, the market sold off between 300 and 400 basis points, depending on where you were on the yield curve. And a lot of that sell-off returned when the Reserve Bank made the announcement of the bond buying. So if you had the cash available, you're not constrained by this liquidity crisis. You could have made a lot of money. We knew what we needed to do and wanted to do. We just couldn't because the markets were just not trading. So that really tested us to the point that we're rethinking about how we think about liquidity management. We cannot wait for that event to happen. We cannot go through another liquidity event like that. So we have funds with huge derivative exposures. Those funds are impacted. Fortunately, we've been through multiple crises before that, and so we were in a good position to know, okay, we can tolerate 100, 200 basis points sell-off, no problem. But then as the market continued, that obviously added a bit of stress to the system. We were still able to manage that. Jason and I were getting up at 5 a.m., working from home in our pajamas, trying to decide, okay, are we okay for today? Can we make our margin calls, etc. And we managed through it. I think there is still something more systematic we need to put in place to make sure that we can prevent those conversations. I don't want to get up at 5 a.m. again, to put it bluntly. But liquidity is, as the markets are developing, more and more players are entering our space. More and more funds are making use of derivatives. I think that just creates more systemic market risk. And so unless you have a plan in place to deal with that, you will have another crisis.
Oh, I think we also need a plan in place to think about Jason's pajamas. Just maybe your thoughts, Jason, when you think about these crisis events. I mean, there's a few that Daphne pointed out. You get to August, what seemed like the most severe is this COVID matter. You almost feel like they're either going to bring people closer or create friction. I don't know if it was exciting, you guys seeing each other in pajamas and 5 o'clock wake-ups, just in that context.
Yeah, I mean, definitely COVID is definitely the top of the list. I mean, I definitely grew closer during that time in numerous ways. But importantly, just for context, you might ask, why are we using derivatives in a fund like the Infrastructure Development Bond Fund? And the primary reason is it's utilized as an alpha transfer strategy. Probably over the last 12 years or so, we've seen a move away from fixed rate credit instruments where borrowers have been issuing JIBAR-linked instruments. Given the fixed rate nature of the fund, we need to then position the fund in such a way to ensure that we are positioned best to highest view using these derivatives, primarily listed futures. In saying so, there's variation margin that comes into play, and given those massive market moves that Daphne spoke to, we were having daily margin calls that came into play. So it was quite tough managing that, also in a world where the market had dried up from a liquidity perspective as well. So we were looking at using internal funds, but also then speaking to the SARB to free up lines as well across the banking market. But ultimately, it was around managing risk, ensuring that you had enough liquidity in the fund to meet those massive margin calls when they were required.
Sure. I think it would be tough enough just for everyone to define what margin call really means, let alone manage a portfolio at the same time. But definitely sounds like to have been a hairy time at that period. There was a time when I didn't work here, and Futuregrowth was very famous in the press, in the media. This was the suspension of lending towards certain state-owned enterprises on the basis of governance and being able to price that governance in. And as a house such as Futuregrowth, these matters are important to the investment thesis. At the time, Andrew was leading the firm. Andrew Kenter was the CIO at that time. Just touching on that, Jason, how does that decision sit within the fund's broader philosophy? Was it a crisis response, or was the philosophy working exactly as it should have at the time?
So I think it's important to clarify that the decision didn't come out of nowhere. Even though Andrew was our spokesman, it was a collaborative approach. It was a decision that we took at a credit committee late in August 2016, where we decided that we didn't have enough of a body of evidence to support continued investments into these SOEs. So what followed was an intensive engagement with various SOEs over an 18-month period. Some allowed us in the door, others shunned us. Land Bank, in fact, was the first one that we approved from a governance point of view through various disclosure requirements. But I think ultimately what followed was the level of state capture pretty much gave us a good sense that we were on the right track.
Daphne, anything that you observed at that point from a risk perspective?
Not particularly. I mean, I think what you have to remember up to that point, that the state-owned enterprises were sort of the key developmental investing vehicles that we used in funds. The private debt market wasn't as established as it is now. So your Escoms, your Transnets, DBSA, those were primary issuers in the listed credit market at the time. And sort of entities we invested in because, we're investing for social good. We need Eskom to flourish and work. We need Transnet to flourish and work for the economy to grow. So it was important for us to invest in these entities, but they needed to be viable. And to Jason's point, we had these governance concerns, which proved valid after the fact. And our process sort of raised these issues. So we were not going contrary to investment philosophy. This was just sticking to our knitting. We drew hard lines. It's either investable or it's not.
Thanks, Daphne. This gets to the climax point, and it's exactly the point when we're closing the first segment. We've covered quite a lot of ground in this segment. We spoke through the founding thesis. We spoke through the early days, the philosophy, the debates, the ownership transitions. It's moments that really tested both the portfolio and the people in your teams that you are on. But what comes through for me really in this discussion is that this returns that matter item is not just the marketing line. It's really a way that we manage funds for our clients. So in the next segment, we get into the mechanics. How does the fund actually invest? What has the renewables journey looked like? And what does 30 years of discipline look like in practice? If you are enjoying this conversation, follow or subscribe so you don't miss the following conversations. Thank you, Jason and Daphne, and thank you for joining us.